free cash flows. So this is a chart for the 9 companies, 9 non-financial stocks in our consistent compounders portfolio as of today. If you do a simple sort of weighted average using their allocations in our portfolio as the weights, if you do a simple weighted average of their free cash flow growth over the last 15 years, this is how the chart will look like. The bars standing tall are the years when the free cash flow for the overall portfolio on a weighted average basis grew on a year-on-year basis, and the bars hanging down below the zero line are the years when free cash flow became negative. As you can see, FY22 has been a massive negative year, but this is not the first time when free cash flows for this portfolio have turned negative. It is actually over the last 15 years, the fifth instance when free cash flows have turned negative. Now, one very interesting facet, every time the free cash flow has turned negative, over the next couple of years, the slope of the free cash flow line, which is sort of the bold line you see here, and the encircled portions is what I'm trying to emphasize on. The slope of the free cash flow line accelerates. It increases as the aftermath of a negative free cash flow year-on-year development bears its fruit in terms of accelerating free cash flows in the subsequent years. Why does this happen? This typically happens because the negative free cash flow years are not signs of any weakness in fundamentals. They are actually signs of accelerated investments. Those accelerated investments, they yield outcomes which are favorable to these portfolio companies, either in terms of accelerated revenue growth or accelerated operating efficiencies, or a combination of both, which leads to the next couple of years undergoing an increase in the slope of the free cash flow line progression that you see, right? Pretty much that is what we expect the more recent capital allocation decisions to deliver over the next few years. What are the capital allocation decisions? Very quickly, first, looking at empirical evidence before we talk about FY22. So these are, let's say, 3 of those 5 years when free cash flow of most of our portfolio companies was negative, right? FY9 obviously was a crisis of different sorts. It was significant volatility in input cost, and for some of the companies, even uncertainty on the horizon around some sort of export-import related sort of demand supply of either their products or raw material, etc. And FY09 saw massive investments into sort of capitalizing on the opportunity. But more importantly, look at FY12. FY12 was not a year of crisis. It was in fact a year when there were ample amount of opportunities to deliver growth. I mean, this is the time when most, even largest of all companies used to report very healthy revenue growth, and India was going through a massive boom in consumption. Many of these companies, they accelerated capex to double their capacities from 2012 to 2013, and that led to massive acceleration in volume growth, revenue growth in the subsequent years. FY18 was a very interesting period. FY18 was when many of these portfolio companies, they tried to benefit from the aftermath of demonetization and GST, 2 events which led to massive disruption in the fundamentals of these companies, right? It's not that FY18 for revenue or earnings was a remarkable year. In fact, these disruptions, they sort of caused a lot of turbulence in the reported fundamentals of these companies. But rather than trying to worry too much about those turbulent quarters, these companies actually accelerated their investments towards working capital cycle, towards capex, in order to benefit from the aftermath of GST and demonetization. Again, as you can read in the text at the bottom, many companies, they double their capacities. So Asian, Berger, Pidilite, all of these companies in our portfolio, they double their capacities. Even Nestle, it accelerated capex in some of its facilities, state-of-the-art facilities, etc. In the subsequent periods, and that has led to the last 3-4 years double-digit volume growth, new category expansion for many of these companies, and hence healthy fundamentals in the subsequent quarters. That's exactly what we expect to see over the next few years. Because if you just let's say look at three types of capital allocation decisions, the first one is loading up on raw material inventory when you saw forthcoming global supply chain disruption as the Russia-Ukraine war and Chinese lockdowns progressed during the Jan-Feb-March quarter. And that has led to some of these portfolio companies sitting on readily available cheap cost raw material for the month of April, May, and June 2022, which I think you will see the impact of when the June quarter numbers get reported, versus competition where availability as well as price of raw material will be unfavorable. These companies will be able to report benefits of the working capital stocking up that they did during the Jan-Feb-March quarter. The second type of working capital initiative was the likes of, say, a Titan or a Page, which loaded up on finished good inventory in anticipation of an upward spike in their end product demand, right? So Titan very clearly articulated that they are expecting a very good Akshaya Tritiya, which now in hindsight we can see they've reported their 30th June results with a 23% 3-year CAGR in jewelry sales, a 250% year-on-year growth, and one of the best Akshaya Tritiyas they've had in the past. Obviously, they were benefited during the quarter by the fact that they had loaded up on finished good inventory, which did lead to their inventory days go up and free cash flows get adversely impacted. But that was a temporary tactical strategic decision which unwinds into a favorable outcome in the quarters to come. Likewise for Page Industries, yet to report their June quarter numbers, but quite clearly indicated in the December quarter results that they've loaded up on fast-moving finished good inventory of products ahead of a quarter where they expected demand to sharply shoot upwards. And this is again forthcoming benefits from tactical strategic capital allocation decisions. The third type of capital allocation decision which led to free cash flows turning negative was accelerated capex. So whether it be Pidilite, which I've encircled here, or whether it be many of our other portfolio companies, which you can see on this slide, there are three types of capex accelerating initiatives that these companies have taken. I've talked about it in the previous webinar, so I'll not spend too much time on it. The first one is around acquisitions. So Pidilite acquiring stronger competitor Araldite, Dr. Lal PathLabs acquiring new geography player Suburban, and Asian Paints acquiring a couple of companies in a new product category vertical, home decor, HDFC Life and ICICI Lombard acquiring their competitors. That's accelerated acquisitive activity in this portfolio. Only a part of it has so far played through in fundamentals. A bulk of it is yet to see its beneficial impact getting reported via fundamentals. The second type of capex decision which has led to accelerated investments is tech adoption, systems and processes, which have actually led to a near doubling of the channel sizes for many of these companies. So Jockey has doubled the number of dealers that it services from 55,000 2 years ago to more than 110,000 today. Asian Paints has increased its dealer network size from 90,000 dealers 2 years ago to more than 145,000 dealers as of today, and so on and so forth. I mean, these degrees of network expansion that these companies have achieved, despite the fact that 2 years ago they were large, in many cases, majority market share controllers in their respective industries, is not a small achievement, and actually talks about how the sort of demand forecasting softwares, the auto replenishment systems, and various other tech investments that they've done, how they have helped manage widening of SKUs, deepening of their distribution networks, and higher returns on capital for both their channel partners as well as for these companies progressively. this will meaningfully add to their sort of competitive advantages in the years to come and deliver acceleration in growth as these channel partners, the newly onboarded channel, it starts selling the products in the quarters to come. Right. The third type of capital allocation decision is complete business transformation. So whether it be an Asian Paints, which is expanding the home decor bit, more than 10% of revenue across home decor and home improvement coming in FY22 for Asian Paints, and targets of very rapidly expanding this number, and the contribution of it to overall Asian Paints is revenues, or Bajaj Finance sort of transitioning from being a lender to a fintech company over the last couple of years are signs of sort of attempted benefits from the crisis by using capital allocation to your advantage, which obviously leads to free cash flows turning negative in the short term, but massive benefits in the longer